So when I was researching for this video into the highest dividend yield stocks on the ASX, AGL Energy seemed to come up quite a lot. And that's for good reason, because at the time of recording this video, the AGL Energy Dividend Yield is a massive 8.12%. So naturally, this got me interested because these are the sorts of returns you would see from the overall market as a whole, not just from the dividend yield itself. But there are a few very important things that you need to know about this. So in this video, we'll explore, number one, why the AGL dividend yield is so high. Number two, why this could actually be a trap. And number three, AGL company analysis and outlook. Hey guys, welcome back to the channel. My name is Fyzee and I make videos about Aussie personal finance. And today we're doing a brief look into AGL. And if you're new here, welcome. First and foremost, as usual, I'm not a financial advisor. This is not financial advice. And as this guy says, please do your own research. So a quick look at the stock price before we begin, and you can see that it's taken a bit of a nosedive from 2017 highs, and the pandemic hasn't done them much good either. The 6-month return is about 29%. The 1-month return is not too good either at about minus 10%. The 1-year return is about 41% minus. And if you look at a 5-year chart, it's quite low as well at about 32%. So it is quite obvious that there is a negative downtrend for the last 3 years. So generally speaking, this affects the dividend yield and it causes the dividend yield to go up as the share price goes down. Let's look at AGL's example. So in 2017, the full year dividend was 91 cents. In 2018, it was 117 cents, a 28% dividend increase. In 2019, it was 119 cents. And in 2020, it was 98 cents. Now you can see in the years of 2017 to 2019, the dividends increased by over 30%. But when we look at the stock price, it was trending downwards with a few bumps here and there. So if we compare April 2017 to April 2019, the fall was about minus 20%. So based on the dividend yield formula, the annual dividend was increasing while the stock price was decreasing, and this is why AGL was kind of known as a high dividend stock for those years. And a lot of websites even recommended AGL to be a high dividend stock, as you can see with these examples. However, in 2020, the dividend was cut back by almost 18%, but the share price kept falling as you saw. And that basically caused the yield to go higher and higher. In fact, the dividend yield when the final 2020 dividend was paid out was about 6.8%, and since then, the yield has gone up to 8.12%, and the only reason is not because the dividends have increased, it's because the share price just keeps on falling. So that brings us to the dividend yield trap. And this is a trap for exactly this reason, which is the dividend yield is comparing past dividends to today's stock prices. So basically speaking, it is a lagging indicator because we know the stock price every single day and it's real time, but we only know about the dividends on announcements. So although this yield looks absolutely amazing, the stock price has declined quite a lot, which obviously shows that the market has considerably less confidence in them as a business for the time being. Now, AGL isn't the first company to be in this situation. This has happened quite a few times, for example with Telstra. So Telstra's stock price had been falling since mid-2015. However, investors tolerated the poor stock price performance on the condition the company maintained its attractive, fully franked dividend. The dividend yield crept up as the stock price plummeted, peaking at around 9% in November 2017. Now, this is very similar to the AGL scenario. In a bid to preserve the balance sheet strength and operational flexibility, Telstra was forced to cut its dividend from 30.5 cents in fiscal 2015 per share to 16 cents in fiscal 2019, which is a decline of nearly 50%. So another example is Pact Group Holdings. In November 2018, the company's dividend yield reached a 5-year high of 6.71% as the stock price sunk below $3.50. Pact had been steadily growing its dividend since 2014 from 9.4 cents per share in fiscal 2014 to 23 cents per share by fiscal 2018. However, in fiscal 2019, Pact's stock price crashed when management reported a collapse in profits and dividends were suspended. So basically all I'm saying is that do not blindly follow the dividend yields, look into why that is the case. The only reason it's high is because the stock price has itself plummeted quite a lot. And guys, if you're finding value so far, please leave a like, it really helps me out. Funnily enough, on 13 August 2020, they announced a special dividend program over the next 2 years. So in FY21 and FY22, Under this special program, AGL anticipates paying special dividends of up to 25% of underlying profit after tax, thereby augmenting AGL's dividend policy payout ratio of 75% to take the effective payout ratio to 100% of underlying profit after tax over this period. Now there is a cost to this, and the cost is that AGL announces that it will reduce the franking on dividends to 0 in FY21 and 22 while it utilizes historic tax losses. So you can see for the past couple of years they have been maintaining a steady 75% payout ratio, but this is now going to change that. So in exchange for higher dividends, the shareholders will not receive franking credits. Now this is only temporary, and by FY23 interim, the franking credits should return to normal. Now it seems to me that they are using their special accounting tricks to change things for the time being. And to be honest, 3 years is quite a long time, so things may even change by then, who knows. So with the dividends, these are paid out of the earnings, and for a good dividend stock, we need the earnings to increase as well. Otherwise, the dividend itself simply cannot keep increasing, it's just not sustainable. And if we look at the last 5 years, the profit after tax was steadily increasing until 2019, as this was the peak. So FY16 it was 701, FY17 802, 1018, 1040, and then there was a huge dip in FY20 at 816. And to top it all off, in their August 2020 announcement, their FY21 guidance was even lower than 816. So they announced that the underlying profit after tax will be between 560 million and 660 in FY21. And the reason for this lowered guidance is because of COVID-19. The wholesale gas gross margin is expected to be approximately $150 million lower than FY20. And the electricity gross margin is going to be lower as well by about 150 million as well in FY20. So far things are not looking as good, but it gets even worse. In December, they made another announcement downgrading their underlying profit after tax even more. So the announcement basically said that the guidance has been reduced to 500 million and 580 million, down from the previous guidance range of 560 million to 660. So guys, if we compare that to the 5-year summary, in FY19 it was 1.04 billion underlying profit after tax, and now in FY21, just 2 years later, it's going to be potentially half. And as you can see, this news caused the share price to fall even more by about 10%. So basically through this, you can see the series of events as to why the share price is so low now and why the dividend yield is higher than ever. And if you just blindly invest just seeing a very high yield, then it's not really a good strategy. But with all of this in mind, is the stock undervalued? That is the question. So if we look at the company's PE ratio, which is the price to earnings ratio, it seems super cheap, considering that it's only 7.6 times earning, while the actual industry is about 20 times and the market is around 23 times. It might seem that the share price is trading at quite a discount. And also based on the DCF model, which is a discounted cash flow model, the fair value is estimated to be $25.60, which is double the price right now. And if we look at the Morningstar estimate, they estimate it to be $16.01, which still could mean that AGL is undervalued. Personally speaking, what the analysts predict and what actually happens in the market can be hugely different, and I think potentially AGL could even go lower, or I could be wrong, but that's just me. All I know is that I don't have any investments in them at the moment, and I don't plan to invest in the future as well. But what about you? Are you going to be investing in this? Let me know your thoughts below, and please like and subscribe if you enjoyed the video, and please support the channel, it really helps out a lot. This was actually one of my first stock videos, so please give me feedback. And thanks guys, I'll see you in the next one. Okay.